To build a strong portfolio, it's not just about the stock price. A good stock is often one that's moderately volatile, highly liquid, and backed by a solid market cap. The kind of stock that gives you flexibility, potential growth, and stability all at once. But what exactly do we mean by liquidity, volatility, and market cap? And how do you use these concepts when picking stocks for your portfolio? Well, we've got you covered. From how a company sells its stocks to understanding market capitalization, liquidity, and volatility, this video explains 15 essential terms every beginner investor should know. Let's get started.
Before a company can sell its shares to the public, it has to go through a big change. Let's break down what makes a private company different from a public company and why it matters for investors. A private company is a business that is owned by a small group of people, usually founders and early investors. A private company's shares are not available to the public, which means you just can't buy any part of that business ownership. Examples for private companies are SpaceX, IKEA, and Bloomberg. Now, sometimes a private company wants to expand. To do this, it goes through a process called an initial public offering, or IPO. During an IPO, the company sells shares to the public for the first time, officially becoming a public company. So now you know what makes a company public. A public company is a business whose shares are listed on a stock exchange, which means anyone can buy or sell them. Public companies must follow strict rules and comply with regulations, and regularly report their financial performance. Examples for public companies are Apple, Microsoft, and Amazon.
Let's talk about stocks and shares. A stock represents ownership in a company. Buying a stock means you own a part of that company. When you buy stocks of a company like Apple, you literally own a piece of that company. Now, a share is the way we count that ownership. The more shares you have, the bigger your piece of that company. In simple terms, stock equals ownership and share equals your percentage of that ownership. Owning stocks or shares gives you certain rights, like participating in company growth, receiving dividends if paid, and sometimes voting on company decisions.
Equity is a similar concept. Equity is another word for ownership in a company. When you own equity, it means you have a claim on a company's assets and profits. In practice, owning equity usually comes through owning shares of stock. So if you buy shares in a company, you are essentially holding a piece of that company's equity. Equity not only gives you potential financial gains as the company grows, but it also sometimes comes with voting rights, letting you have a say in key company decisions. Think of equity as the slice of the company pie that belongs to you. The bigger your slice, the more ownership you have. Let's get into the market now. A stock market, or stock exchange, is a large marketplace where stocks are bought and sold. Think of it like a busy market, but instead of buying clothes and accessories, you're buying pieces of companies. There are over 60 major stock exchanges around the world, spread across more than 50 countries. Some of the most famous include the New York Stock Exchange and NASDAQ in the US, the London Stock Exchange in the UK, and the Tokyo Stock Exchange in Japan. These exchanges provide a regulated platform where buyers and sellers can trade shares safely and efficiently. They also help determine the price of a stock through supply and demand. If many people want to buy a stock, the price rises. If more people want to sell, the price falls. In short, a stock exchange is the hub where ownership in companies is exchanged, making investing accessible to the public worldwide. A ticker symbol is a short, unique code that represents a company on a stock exchange. It's like the company's nickname for the market, making it quick and easy to identify. For example, Apple's ticker symbol is AAPL. Tesla is TSLA. Google's parent company, Alphabet, is GOOGL.
Ticker symbols are essential because many companies may have similar names, but each ticker is unique. Investors, brokers, and financial news all use ticker symbols to track stock prices and trading activity efficiently. Think of it as the stock market shortcut, a small code that tells you exactly which company you're dealing with.
A broker is a person or a platform that helps you buy and sell stocks. You can't directly trade on a stock exchange as an individual. You need a broker to place your orders. Brokers can be traditional firms like Fidelity or Charles Schwab, or online platforms like Robinhood. They act as the middleman between you and the stock exchange, making sure your trades are executed safely and efficiently. In addition to executing trades, brokers often provide research tools, market data, and account management features, helping investors make smarter decisions. Think of a broker as your gateway to the stock market. Without them, you wouldn't be able to buy or sell shares.
Commission is the fee a broker charges for helping you buy or sell stocks. Think of it as the cost of using their service. In the past, almost all brokers charged a commission for every trade, which could be a flat fee or a percentage of the trade amount. Today, many online platforms offer zero commission trading, but some brokers still charge for specific services or certain types of trades. Understanding commissions is important because fees can eat into your profits, especially if you trade frequently. Even a small fee per trade can add up over time. In short, a commission is the price you pay to access the stock market through a broker.
Portfolio. A portfolio is simply the collection of all your investments. This can include stocks, bonds, ETFs, mutual funds, or any other assets you own. For example, if you own shares in Apple, Microsoft, and an index fund, together, they make up your portfolio. Think of it as your personal investment menu, a snapshot of everything you own in the market. Portfolios help investors diversify risk. Instead of putting all your money into one stock, spreading it across multiple investments can help balance potential gains and losses. In short, your portfolio is a map of your investments, showing both what you own and how your money is allocated. Capital gains and losses. A capital gain happens when you sell a stock for more than you paid for it. For example, if you buy a stock at $50 and later sell it at $70, your capital gain is $20. On the other hand, a capital loss occurs when you sell a stock for less than you paid. If you bought a stock at $50 and sold it at $30, you'd incur a $20 loss. Capital gains and losses are the core way investors make or lose money in the stock market. Understanding them is essential because they directly impact your overall returns and can have tax implications in many countries. In short, capital gain is a profit from a sale and capital loss is a loss from a sale. A dividend. It is a portion of a company's profit that is paid out to its shareholders. Not all companies pay dividends, but many do, especially large established firms. For example, if you own stock in a company that declares a dividend of $2 per share, you receive $2 for every share you own. Dividends are typically paid quarterly, though some companies pay monthly or annually. Dividends are a way for investors to earn income from their investments, in addition to any potential gains from the stock price increasing. In short, a dividend is a cash reward for being a shareholder, representing a share of the company's profits.
Now, as you know, let's talk about dividend yield. Dividend yield shows how much a company pays in dividends relative to its stock price, expressed as a percentage. It helps investors understand the income potential of a stock compared to its cost. For example, if a stock costs $100 and pays $4 in annual dividends, its dividend yield is 4%. Dividend yield is especially useful for income-focused investors like those planning for retirement because it shows the return you're getting just from dividends, independent of any price changes in the stock. In short, dividend yield is the percentage return you earn from dividends based on the stock price, helping you evaluate the income potential of an investment.
Market capitalization. Market capitalization, or market cap, is the total value of a company based on its current stock price and the number of shares outstanding. It gives investors a simple way to understand how big a company is. Market cap is calculated by multiplying the stock price by the total number of shares issued. For example, if a company has 10 million shares outstanding and the stock price is $50, the market cap is $500 million. Companies are often categorized by market cap. Large cap, big, established companies. Mid cap, medium-sized companies with growth potential. Small cap, smaller, often riskier, but potentially higher growth. In short, market cap tells you the overall value of a company in the stock market and helps compare companies of different sizes.
Volatility. Volatility refers to how much a stock's price fluctuates over time. A highly volatile stock experiences large price swings, while a low volatility stock remains relatively stable. For example, technology stocks often have high volatility, with prices jumping up or down quickly. Consumer goods or large established company stocks, on the other hand, tend to have low volatility, moving more gradually. Understanding volatility is important because it helps investors gauge risk. High volatility can mean bigger potential gains, but it also comes with higher risk of losses. In short, volatility tells you how unpredictable a stock's price is and helps you decide how much risk you are willing to take.
Liquidity is how quickly and easily an asset can be bought or sold without significantly affecting its price. For example, stocks of big companies like Apple or Microsoft are highly liquid. You can buy or sell them almost instantly at the market price. Smaller or lesser-known stocks may be less liquid, meaning it could take longer to sell, or selling quickly might lower the price. Liquidity is important because it affects your ability to access cash when you need it and helps you understand the risk of getting stuck in a position. In short, liquidity tells you how easily you can convert your investments into cash without losing value. Now that we have covered 15 basic stock market terms, that means the sentence we started with makes complete sense. A good stock is often one that's moderately volatile, highly liquid, and backed by a solid market cap. Comment below if you understand what this means. By understanding these basics, you can start looking at stocks and the market with confidence, knowing what makes them risky, stable, or valuable. Master these 15 terms, and you've got the foundation to make smarter investment decisions.
Subscribe to Assetly Academy and follow us for more videos like this to keep learning the stock market, investing, and personal finance in simple, easy-to-understand terms.